What's the investing equivalent to a crash helmet? Let's open this crash helmet. If you've got a pension, a SIP or an ISA, what is the investing equivalent to protecting yourself from the unexpected? Well, rather like a crash helmet, actually one of the things you're looking to do is have peace of mind. And that's often overlooked when it comes to investing. So how do you get peace of mind on your investments? There's several tricks that I use and I recommend people to do. I'm Alpesh Patel, I'm a hedge fund manager. I've written numerous books on investing, which you can download for free, such as Investing Unplugged. Just go to alpeshpatel.com/links for that. Let's get back to this question of crash helmet protection for your investments. Now, one of the ways, of course, to remove volatility, because that's what's causing you the emotional distress, the worries in your investment portfolio, is to hold more cash. Okay, but we usually want quite a bit of growth as well. So there's two things that I like to do with companies that I've selected as appropriate to be in my pension. And how do I come to those? I'll come to in a second. But once they're there, the two things that I like to do is reward and risk. The reward is based on a projection forward of the existing trend. And if there isn't an existing upward trend, then historically the growth trends that they've had during past periods. And that angle of inclination projected forward for 12 months, will it give me ample return and give me a massive buffer, a safety net? Okay, bit like the cushioning in here. So the point being, if it gives me 40% in a year projected forward, then even if it were to do half of that because there was a crash, then at least I'll be protected. Actually, if there's a crash, we'll probably go into cash. In other words, just get off the track entirely. But let's say we don't do that. We have to go slow. Then at least it's given me some projection for the future. And if it can't achieve that projection, then what the hell am I doing with that stock anyway? The second part, the flip side to reward, is the risk. And the risk I measure by two things. One is historic drawdowns. In other words, peak to trough falls. 10%, 15, 20, 25%. Now, if you can't take at least a 20 to 25% drop in a stock, then you've no business being in the stock market, because even the mighty Microsoft, and one of the least volatile companies, does that. Okay, so that's the first thing, drawdown, depth of drawdown. The next thing is time to recovery, duration of drawdown. So how long before, again, crash helmet intact, you can get back on the track? And that's basically how quick will the V-shaped recovery be. Now, if you want it under 6 months, you've no business being in the stock market, because most of the times, for most stocks, even the mighty Microsoft, when it went up 50% plus in 2001, and that's a good case study, 50% in a year, it had 9 months where it gave you 0% returns. Indeed, 3 times it dropped 10% peak to trough, even though you got 50%. And that's the best of the best of the best, unless you're going to Vegas and putting it all on black. So drawdown depth and duration measures your risk appetite. Projection forward measures your reward. However, which stocks? You could do that with any random stock, doesn't mean it'll work. They still need to be undervalued, revenue growing, dividend yielding. And those are the types of stocks that I'll want in my pension, my son's junior ISA. Have a look at the links in the bio, alpeshpatel.com/links, to learn more. Lots of free materials there. The biggest mistake people make is they think they can only pick value stocks or growth stocks, or they go to an IFA wealth manager at somewhere like St. James's Place and they just shove a load of stocks in, spray and pray. Now, the reason wealth managers do that to you is because then they've always got enough to come back to you once a year when they speak to you and say, oh, well, that one did well, or that one did. Oh, well, you can't win them all. Okay, and that's a major problem when you're not getting growth in your pension. Anyway, that essentially is how you get a crash helmet in your investments. More to follow. Do like and follow for more videos. Thank you.